You might think keeping your money in a savings account is the safest move, but while you sleep, that cash actively loses its value. This chart shows a standard bank interest rate of 6%, but factor in reality, 5% inflation immediately swallows those gains. Then, if you exceed your tax exemption, the government taxes the rest. Your real-world return drops below zero. Realizing this, many people rush out of the bank and into the stock market. But the market has its own hazards, specifically 3 invisible traps designed to quietly drain your capital over time. Keeping your money in cash guarantees a slow bleed of your purchasing power. Building real wealth requires market exposure, but you have to know exactly how to navigate those traps. The first hazard is the fee trap. In South Africa, the average total expense ratio on an investment fund sits around 1.5%. Compare that to the UK, where the average is just 0.5%, and you are paying 3 times as much just to participate. This chart models 2 identical monthly investments over a 40-year period. The top curve assumes a 1% fee and grows to 13 million rand. The bottom curve assumes a 3% fee and stalls out at 6.1 million. That 2% difference literally cuts your total wealth in half. To find out what you are actually paying, you need to ask your provider for your annual effective cost statement, or EAC. This document breaks down the hidden administration, advice, and management charges eating into your returns. Every rand you pay in fees is a rand that cannot compound for your future. Controlling your costs has a far higher impact on your final balance than trying to pick the next winning stock. The second trap is geographical. Investing locally feels comfortable, but the Johannesburg Stock Exchange represents less than 1% of the global market. Relying solely on that 1% also exposes you to a persistent headwind. Historically, the South African rand depreciates against the US dollar by about 4 to 6% every single year. To escape the rand, investors often buy multiple offshore funds. But this diagram shows what happens when you combine the Nasdaq 100, the S&P 500, and the MSCI World Index. Instead of spreading your risk, you are buying the exact same top US tech companies 3 times. This is an error known as diversification. You are increasing your concentration in a single, volatile sector, while assuming you are doing the exact opposite. Effective global exposure requires buying distinct parts of the world market, not just piling up overlapping offshore funds to get away from the local currency. The third trap is psychological. When the market drops, fear takes over. Investors panic, sell their assets at the absolute bottom, and then wait to buy back in until prices are high again. You might think paying a professional active fund manager solves this, but the data shows that 77% of active managers in South Africa fail to beat their benchmark index over a 5-year period. Human beings are wired to make emotional financial decisions, and paying high fees for active management rarely yields better results. Trying to manually time the market is a statistically losing game. To actually protect your wealth, you need to use the legal structures available to you. In South Africa, the most effective tool is the tax-free savings account. This progress bar tracks your strict annual contribution limit. The government allows you to put in up to 46,000 rand per year. But if you cross that line by even 1 rand, you are hit with a massive 40% tax penalty on the excess. As long as you stay within the limit, every cent of capital growth, every dividend payout, and all the interest generated inside that account is completely immune to tax for the rest of your life. Taxes are one of the heaviest drags on long-term growth. Because of this, failing to max out your TFSA before making any other investments is mathematically equivalent to giving away free money. The most effective strategy strips away all the complexity. You open a TFSA and you purchase a single, low-cost, globally diversified index fund. Then you automate the entire process with a monthly debit order. The money leaves your account before you can spend it, buying into the market whether prices are up or down, entirely removing your emotions from the equation. Building wealth does not require predicting the future or outsmarting Wall Street. You just have to eliminate local bias, cut your fees to the bone, automate your contributions, and then have the discipline to step back and do absolutely nothing.